root of the problem in 2009. These were CDOs, which were derivatives backed by mortgages. The underlying asset was a mortgage. And CDSs, those were insurance on the CDOs. Let's look and see how big the derivatives market is today. You can see this visual representation of the world's stock markets that total about 73 trillion. Let's scroll down here and we get to the global money supply. So this is the amount of money that's basically in the world. That's about 90 trillion. One thing I want to point out before we get to the derivatives is the global money supply is 90 trillion, but the global debt is 215 trillion. So there's far more debt in the world than there is money to actually pay that debt. But that's a topic for another video. So going down to the derivatives market, you see how big the global debt is as far as a visual representation. You see how big global real estate is. At the low end, the derivatives market is 544 trillion with a T. On the high end, the derivatives market is 1.2 quadrillion. And back in 2003, Warren Buffett said that these derivatives are financial weapons of mass destruction. I think that says it all. And here you can see how massive the derivatives market is today. And if you think those graphs are scary, I want to remind you that these derivatives are comprised of not just mortgages and insurance on the mortgages, but any asset. And we're going to talk about that more in reason 3. And let's focus on housing for a moment. Today, mortgage debt is higher than it was in 2009. And you may say, George, well, that's no big deal because the underwriting is a lot better today. And that may be true, but check this out. In 2009, we know that the bad mortgages are what made the CDOs go bust. But today, what's going to happen in 2020 or in the next recession is the recession is going to make those mortgages, the ones even with solid underwriting, go bad, and that's going to have the same effect of making those CDOs go bust. The second reason the recession of 2020 will be larger and greater than in 2009 is we have much more debt. The recession in 2009 was caused by a debt bubble, and the debt bubble we have today is absolutely massive. Check this out. Auto loans have increased by 50%. Student loans have increased by 100%. Mortgages are the same, but the total outstanding debt in the private sector has increased by 85% since 2009. So if we had a debt bubble in 2009, what on earth do we have today? And I haven't even talked about the public sector. The public sector debt went from about 10 trillion in 2009 to today it's over 22 trillion. It's gone up by over 100%. The third reason is asset prices equal the economy. The consumer is 70% of the US economy, and their assets are in 3 categories: home equity, stocks and bonds, and pensions. The pensions assets are mostly corporate debt, and the quality of corporate debt is reliant upon stock prices. So if we have a stock market crash like we did in 2009, in the next recession where it goes down by 50%, that's going to completely blow up the corporate debt market. If it blows up the corporate debt market, it's going to blow up the pensions. That's going to eliminate one of the assets that these consumers have at their disposal. Then the stock prices will have gone down by 50%, so that eliminates stocks. And then you say, well, we've got the home equity here. Well, not really, because this whole process is going to completely freeze the credit market, just like it did in 2009, and that's going to prick housing bubble 2.0 that we're in right now. And you say, well, George, well, at least they've got the bonds. Well, let's think this through. If that all happens, what's the Fed going to do? They're going to print money like they have never printed money before. And that's going to make the long end of the yield curve spike. Interest rates go up. If interest rates go up, what happens to the value of bonds? They go down. Bonds are gone as well. If the consumer loses the majority of the wealth their spending will plummet. If their spending plummets, the economy plummets. And that creates a recession that is far worse than what we saw in 2009, potentially even a depression. Number 4 is malinvestment, which is basically bad investment. This comes from the Austrian School of Economics, their business cycle theory. And it kind of works like this. Let's just go back to 2006 as an example. We've got interest rates being lowered. When interest rates go artificially low, that creates artificial demand. Going back to 2006, people used their home equity as an ATM machine, and they spent more because they had all of this paper wealth that really didn't exist except for in just a nominal price on their home. And I remember back in around 2012, after the bubble had burst, I moved to Puerto Rico. And when I first went into the Puerto Rican airport, I noticed that a whole entire wing of the airport was just a ghost town. I mean, there's tumbleweeds going through. All the stores were closed, and it looked like it hadn't been used in years. And I inquired as to what happened, and sure enough, when all of this paper wealth was created and all this excessive demand was created, all the people flooded down to Puerto Rico to vacation from the United States because they had all of this home equity money that they're using, and they felt really confident because they had all this paper wealth. The Puerto Ricans, the entrepreneurs there, they see all of this demand coming in, so they increase supply. They go into the airport, they set up new stores. They take their life savings and invest in building out these stores, and they allocate resources that could have been used in other parts of the economy. Very simple example, to build out these stores, they've got to use 2x4s. So they've got to cut down a lot of trees that they use for lumber for their stores. Additionally, they've got construction workers. If there's a big construction boom, a lot of these people coming out of high school or college, well, they might go into construction and learn that skill as opposed to going into something else that maybe doesn't pay as well, or there might not be as much demand for that type of work. Then this demand goes back down to where it naturally would be. All those extra people that were vacationing down in Puerto Rico are now gone. So these stores aren't making any money. They have to close their doors. They lose all their savings. And think about these resources. All these trees were cut down to provide lumber for all these stores that shouldn't exist in the first place. It wasn't driven by market demand, it was driven by phony interest rates. And then all of these people that got out of college and went into construction, now those jobs are gone. It was a misallocation of resources that could have been used better in other parts of the economy, but the price signal just wasn't there. Now, taking this to where we are in 2019 and going into the next recession, if we have it in 2020, companies like Uber and Tesla would not exist if it wasn't for free money. And we have had 0% interest rates in the United States for 10 years. That's why companies like this exist. With Uber, think of all the workers who have bought cars, who have paid insurance, have done all these things to work for Uber. All that's gone, poof. Tesla, think of all the resources that they use for all of their cars, the batteries, the commodities, the rubber, the human capital that goes into that. It's all gone. And it's a direct result of malinvestment. And let's not forget about the pension funds. Remember, the pension funds can't get a return because of those artificially low interest rates, so they go further and further out the risk curve. They buy riskier assets because they have to have a return. In the next bubble, when that blows up, the pension funds will be in even bigger trouble than they are right now. And this goes back to the everything bubble. Stock market bubble, housing bubble, bonds bubble. It's all a result of malinvestment. Number 5, the Fed has no more ammo. And this is where it gets really scary. But I want to reiterate that nothing in investment, nothing in economics is a certainty. I think that there's a very good chance, the probabilities are high, that we go into a recession in 2020, but it's not a certainty. So you always have to place your bets, whatever you're doing in life, based on the probabilities, just like in blackjack. But getting into this, what are the Fed's current tools to fight a recession? Number one, interest rates. During the last recession in 2009, interest rates, or at least the overnight rate, the Fed funds rate, was right about 5, and we took that all the way down to 0. So we had 500 basis points of wiggle room. Right now, interest rates are right around 1.75. So we only have 175 basis points to get us back down to 0. So there's far less ammunition here in terms of interest rates. Additionally, the reason the Federal Reserve lowers interest rates is to prompt banks to issue more credit. And their idea is that there's all this demand in the future. There's demand to buy cars, demand to buy housing. And if we can lower interest rates down and get the banks issuing a lot of credit, we're going to pull that demand from the future into the present. And that's going to fix this hole that we have in the recession caused by a lack of demand. But we've had 10 years of these low interest rates. So there's just no more demand to pull from the future. It's gone. Everyone that was planning on buying a brand new car has bought a brand new car. Everyone that was planning on taking advantage of 0% interest rates took advantage of 0% interest rates over the past 10 years. So obviously I'm speaking in broad terms. Not everyone has, but the majority of people have already made those purchases. Then they say, well, George, they could take interest rates negative. That is true. But remember that negative interest rates are going to put the nail in the coffin of the pension funds. I keep going back to these pension funds, but they are in deep, deep trouble because they haven't been able to get the 7% return that they need. If interest rates go to negative, they're not going to be able to meet their obligations at all. They're all going to go bust because of all that malinvestment that we talked about earlier. Their second tool is quantitative easing, or QE, and that's when the Fed comes in and they print money to buy bonds to keep the long end of the yield curve down, to keep interest rates down on the 10-year and the 30-year. The problem with quantitative easing is what we've seen in Europe and Japan is there's diminishing returns. You get a big sugar rush from it when you first start doing it, but if you do it year after year after year after year, pretty soon it has no effect at all, and it actually has a negative effect. It makes problems worse because in the mind of a Keynesian or a central bank, it's a little weird, but you got to get into their mind momentarily. It's all about demand. That's the big problem. People just aren't spending enough money. And they may be partially right with the US economy because it's 70% consumer spending. The problem with all these interest rates being so low for so long is it forces people, especially going into retirement, to actually save more money than they otherwise would have. Because if they've got, let's say, $100,000 and they were expecting a 6% return on that, or $6,000 coming in every single year from that $100,000, but now they're only getting $1,000, well, they have to penny pinch and do everything they can, or they're going to run out of money in retirement. And that is just everyone's worst nightmare. So they avoid that by saving more money, which is the opposite of what the Fed is trying to get them to do. And then you could say, yeah, George, but it's not that big of a deal because, again, we could do what Japan's done. Well, let's think about what Japan's done. Remember how one of the 3 keys to the US economy is asset prices. Well, asset prices in Japan are lower today, even adjusted for inflation, than they were in 1990. So now that the US has this economy that's totally dependent on asset prices, debt, and confidence, what happens to our economy if asset prices tank because of a bubble? They go down by 50% and they never recover. What does that do to people's retirement? What does that do to people's willingness to spend money in the future? And everyone forgets one of the key differences between Japan and the United States is Japan had and still does, have an incredible amount of savings. They're the largest creditor nation in the entire world. The United States is the biggest debtor nation in the world, and that makes a big difference. So that brings us over to the end game. If I had to guess, if I had to say the probabilities are the highest that the end game is going to play out in the United States just like this, this is what I would say. And again, we're not talking about certainties, we're talking about probabilities. It starts with MMT, which is modern monetary theory. I won't go into it in great detail because just the simple premise of MMT would blow your mind. It's completely insane. But basically what they say is you can print limitless money. Anything you want, anything the government needs. You don't have to tax people. That's just old, antiquated thinking. You don't need a bond market. You don't need any of that. So if we want to fund these pensions, no problem. We'll just print the money. If we want to give free college to everyone, no problem. We'll just print the money. Social Security, underfunded, no problem. Print the money. Do guaranteed government jobs. So the government will just print money to create jobs so there will be a zero unemployment rate. And if this sounds crazy to you, it is, but do some research and you'll see that on both sides of the political spectrum, this is becoming very, very popular, especially with the people in the Democratic Party. You'll notice that most of their advisors, as far as economists, subscribe to this complete nonsense. And you may be thinking at home, well, George, they're just going to get massive amounts of inflation. And I think you are exactly right. But we as humans have a tendency towards recency bias. We think that whatever's happened in the past few years is just going to continue happening forever. So since we've printed all this money doing QE and these 0% interest rates, we've got Japan, Europe, and they haven't seen inflation, I think that we're just going to whistle by that graveyard. The politicians are going to pretend that inflation is a monetary phenomenon that only occurred in the past. And moving forward, it's something that we don't really have to pay any attention to. Because you think about a bubble, whether it's in Bitcoin or tulips or housing, it's always created by people thinking that something can't happen. They're asleep at the wheel. And the next thing that you know, bam, it hits them. Inflation is going to come in and level the economy when no one is expecting it and take us into an inflationary depression. It's going to happen when it's least expected. For information on how to actually profit from inflation, check out this content right here. And for more information on Housing Bubble 2.0 and the problems that we will face there, check out this content, and I will see you on the next video.